Hi, folks. Dan Bird here with the Daily Scan for Tuesday, May 13th, and it's Technical Tuesday. And as I promised last week, I'm going to cover the Darvas box theory. Talk about that. Nicholas Darvas, who came up with it, how he came up with it, how to use it, and some examples as well. It's a very interesting topic, actually. So, as always, I am not a financial advisor. Everything here is for educational purposes only, and anything that I say does not imply a recommendation to buy or sell anything. So let's take a look first at the market before we get into Darvas. And if we go to the home page, you'll see once again that the bias chart continues to go higher. Very interesting movements today. I'm going to take a look at it on the market bias page for subscribers. You can see lots of green ones, but there's a few red ones too. So the short term actually went down slightly because all these reds are in the short term. But let's take a look at what they are. So this is utilities. This down here is staples sector. This one down here is gold miners. And down here we have the yield curve. So those typically go down. Most of those go down when the market is going up. And we can take a look at each one of these. Here's utilities. The links are right here on the left-hand side. So we'll look at this utilities, and I'll show you where the short-term signal happened right here. So utilities is continuing to drop. Utilities basically are a defensive area of the market. If we look at staples, also a defensive area. XLP, staples, had a big down day today and gave a short-term down signal as well. That's why it turned bearish. If we look at gold miners, gold actually has been coming down quite a bit. So here's gold miners. Also gave a short-term down signal, almost gave one about a week or so ago, but didn't quite cross. But today it did. So it's sitting right on the 50-day moving average. So miners are starting to go lower. Just for fun, let's take a look at gold itself. And you can see gold will probably give a short-term down signal. If it continues down, might give one tomorrow or the next day. But you can see right here, this looks like a double top to me. And that may be the highs for gold for a while. So gold might be heading lower in the short term at least. And then we'll see how it settles out. And then finally, the yield curve down here turned bearish, the 10 and the 2 inversion. And you can see there's the crossover right there, but it basically ended with a spinning top, which is indecision. But it's well above zero. So that's really the important thing for the yield curve, being above zero for the 10 minus the 2 year. But if the shorter term view, it's actually starting to come back up, which is good because it has been inverted for quite a while. This is the 2 year minus the 3 month rates. So the short end is still inverted. It uninverted very briefly over here, but then went back down, and now it's trying to make a run back up to zero. But it still has quite a ways to go. All right, let's go back. And so that's the market bias. You can see right here the short term turned yellow actually today because of those bearish signals in the short term column. But most of the bullish signals are in the medium term. So those are all starting to move higher. Okay, so back here on the home page, we'll take a look at the S&P. And we see it continue to go higher today. I do not expect it to continue at that trajectory. That is getting to the point where it is a little bit too steep, actually. So it's above the 200 day, which is really good. So all of that is good news. It's above the cloud. So these are all very bullish signals, but it's not going to continue going up like this. Now, today, the CPI came in, and it came in at 2.3. I thought it might be lower than that, but it came in as forecasted. So the market seemed like they liked it. A little bit lower as forecast. So CPI looks fine. Inflation looks fine. The next big one, I think, will be the jobs number coming up on June the 7th. So we'll talk about that as we get to it. This little box right here is what I thought might become a Darvas box, but it actually is not really a Darvas box because the market has just continued to go higher. But I'll talk about that in a minute. Let's go back and look at the NASDAQ 100, and it looks the same, actually even stronger today, moving higher. Let's look at the Russell, small and mid cap, sitting right at the resistance line. It has a spinning top candle and right at this downtrend line. So it's really trying hard to get above all of this resistance, and it still has the 200 above it. So it still has quite a bit of work to do, but it's giving it a shot. And then Bitcoin, how does that look today? Bitcoin made a little bit of a comeback, but pretty much ended the day right about where it started yesterday. So recovered quite a bit of yesterday's losses. It's at 104. As I said, 106 is going to be major resistance, and it's still sitting right at that, a little bit below it. So we'll see what happens. Actually, the best thing would be for it to pull back, maybe down here to this 23 Fibonacci level and form a cup, or I'm sorry, a handle for this long cup trend right here. And if it does that and then breaks through, then we'll measure the potential target if it breaks through. But it hasn't done that yet, so that would be the best case scenario. All right, let's jump over to the charts page real quick because I want to show you a couple of things. Last week I was trying to find the earnings chart and had a hard time. There's lots of charts in here, and I don't recommend you try to use all of them, but certainly I would suggest taking a look at them and just trying to understand what they do. But this is sort of like a toolbox where you might use a hammer and a screwdriver quite a bit. But if you ever need an angle iron, it's in here. So the earnings chart is actually called price to earnings ratio. And that's right down here under the sentiment section. So I'll bring that up, and what we'll see, there's the S&P, there's the sell-off right there, which looks very similar to 2018. I'll show you that in a minute. Here's the PE ratio for the S&P. Right now it's at 28. You can see it went all the way down here below 25. As the market sold off, naturally the P part of the PE got lower and lower. But then as the market started coming back, the P side of it started going higher. So it's below 30 still, which is actually what it got to just before the sell-off. So this was, the ratio was pretty high at 30. Normal is somewhere between 20 and 25 down here in this area. And I got down there very briefly and then started going back up again. So we're getting back up to an expensive area. We'll see if that's going to have any effect or not. But what that also means is earnings have actually been coming in pretty well. So here's earnings right here. This whole thing goes back 4 years. So you can see back here in 22, as the market started selling off in 22 during that long bear market, earnings started coming down. And then here in 23, they started coming back up, and they're actually higher than they were in 22. So earnings have not really taken a big hit yet. So that's positive news. If earnings can stay strong, even if the economy weakens a little bit, that'll actually be good news. So, and down here are the CAPE ratio. CAPE is a cyclically adjusted price to earnings, or inflation adjusted price to earnings. So this is the CAPE ratio versus the regular PE, the black one, and the red one is the CAPE ratio versus the 10-year Treasury, which you see is slightly, it's on a downtrend versus the 10-year. All right, let's also take a look at the 10-minute charts, because there's something really interesting going on here. For those that are subscribers, you might, maybe once a week or something, just take a look at these and see what things are looking like for the week. These are 10-minute charts with the aggressive sectors, defensive sectors, and sustainability ratios. So if we look at aggressive first, you can see right there, the last 2 days, the market actually has gone higher, and it went higher again today. This is last Monday's open, was way down here. So clearly trending higher. And these are all the aggressive sectors. Technology continuing to move higher. These is versus the S&P. So how is it doing versus the benchmark of the S&P. The percentages are the amount that it makes up of the S&P. So technology is 33% of the S&P. You want to see that one moving up more than any of them. And it certainly is. It's actually moving up even more. Financials, it came down. It's just sort of going flat. Discretionary is looking great. That's an aggressive communication services, which is where Google is. And Google makes up a big part of that one. It's been coming down because of Google. And industrials, which have been really the strongest sector lately, industrials continue to outperform and continue to move higher. The next one are the defensive ones. And this will really give you a stark contrast between these. So there's healthcare continuing to move lower, staples moving lower, energy hanging in there, just kind of going sideways up a little bit. Utilities, very much down. Materials is down. So all of these, especially staples, utilities, these are all defensive areas, and they're moving lower as the aggressive areas are moving higher. And that's exactly what you want to see in a strong market. Now, the next one is even more important. This is sustainability, or the ratios of growth versus value in a strong market. If Wall Street is buying and they expect the market to move higher in the future, then they are rotating out of value and into growth. That's what this moving up means. So right now it is very strong. Same thing with discretionary versus staples. I just showed you staples had been moving down and discretionary had been moving up. So that ratio then makes the discretionary outperform staples. Technology outperforming the S&P. The technology group, again, these are the ETFs outperforming the S&P, and then semis outperforming the NASDAQ 100, which is also a really important ratio. So all of these are telling us that Wall Street is in a risk-on mode right now, a very bullish perspective, and it looks like that will continue for the short term at least. If we look at the VIX real quick, we looked at this yesterday and it was coming down, and today it's at 18, so it's still below 20, getting closer to that 17 area. Below 17 is where bulls are in control, and it's a red bar, so that means it's going lower. It's even going lower than yesterday. So just continuing to go down. That's great news as the market goes higher. If we look at the comparison with 2018, it is still continuing to show that it's following along with 2018. So here's 2018 at about the same point right here that we are right here. And 2018 started in September, had a big sell-off. 2025 started in February and had a big sell-off. So the months don't match up exactly, but the number of months certainly do. So down here, this is roughly about 1 month worth, a little bit more than 1 month worth for this period from the red line, and that's the same amount over here. This is actually about 3 weeks over here. So we actually are a little bit ahead of 2018. So that's the way it looks. It's still tracking, still looking pretty good. All right, let's now go back over here and look at the dashboard. First, I want to close out some of these. We'll take a look at the dashboard, which we did not really look at yesterday. There's a few things I want to show you there. The dashboard is something that you can create using stock charts. You can make your own dashboard for things that are important to you. You can configure it however you want to. This is how I've configured mine. Equities up here. Some of these widgets they give you, you can just add the widgets that you like. So equities, the Dow you see was negative, but the S&P was positive. NASDAQ 100 was positive. The VIX was down. Came back a little bit at the end of the day. For sectors, technology, consumer discretionary, and communication services are in the top 4. Those are the most aggressive sectors. Energy's up there too, though. So energy seems to be making a move too. Down at the bottom, we've got staples, real estate, utilities. Those are the most defensive sectors, and healthcare as well. And you can see the advancers versus decliners over here. Most of the advancers other than financials. Financials is right in the middle of the pack over here, but it actually had more advancers. So, and this down here shows you whether it's bullish or bearish. These are the past 2 days earnings for the S&P 500. I did not show this yesterday, but NRG Energy, for those that are paying attention and subscribers in particular, NRG was the #1 in my top 10 list over here yesterday. Now today it's in the third group right here. But it did go up again today. So it had a big gap up on earnings and it went up again today. But more importantly, on the charts page on the website, every week I update this section over here for these are the sectors. And these are the top 3 stocks in each of the sectors. And down here are the top 10 lists that I use for one of my watch lists, which I actually provide right here on the website in a CSV file. You can download that into any other platform you want to, if you want to also look at the same stocks that I'm showing on the dashboard. So that's all of these in here in the top 10. If it's red, that means they are also in the top 3 in their particular sector. So it gives you a nice cross-reference. And what you'll notice over here under utilities is NRG. And NRG, if it has an asterisk, that means it's new for this week. NRG does not have an asterisk. So it has been here actually for quite a while. So for those that are subscribers, if you do nothing else but on Sunday, just go and take a look at the sectors and look at the top 3 names in each of the sectors. That's going to give you some really good names to keep track of. And you can see what NRG did as a result. Took off this week. It had earnings on the 12th yesterday and came in with great earnings. But it had been moving up already before that. So this is just an example of how you can use the website to really identify good candidates. If we go back to the dashboard again, this is on the 3rd level. You see Uber right here. It's also on the 3rd level. It's moving higher. If I open up Uber, you'll see that for my daily scan, which I'm starting to do again, it would have hit the daily scan right back here. Actually, it would have hit it twice. It would have hit it here, and then again 2 days later, right here. So that's roughly at about $72, and now it's at almost $92. So $20, which is about 25% move in about a month move up. So I will start doing the daily scan and showing those, but this is a great way, just using this combined list, downloading it in the CSV file and doing your own scans is a great way to find good candidates. If we look at let's look at the ones that are in the top group. HIMS has just been crushing it. HIMS continuing to go higher. You can see right there, it actually hit the daily scan probably right here on this gap up. Pull back a little bit and then continue higher. That's a black handle. So you want to watch the next 2 days, and the second day it started going higher. So could have get in at 35 right there. It's now heading for 70. So that's a double in about 3 weeks for HIMS. And it would have hit the daily scan right there. So that looks pretty good. Also on here is Palantir. Palantir is just continuing to be strong. Mr. Cooper moving higher today. Rubric, these are some that subscribers have asked about. So it's in the top 10 group. It's continuing to move higher. Second group, IESC, doing really well. Roblox, looking great. MicroStrategy, up there with Bitcoin. Third level is where we found NRG and Uber. And CRK, I think, was just added this week. At the end, though, what you'll notice is there's Hertz. Hertz coming down dramatically after having a nice run up. Halo is the worst of the group. So Halo, I think, just reported and missed earnings. If we go back, CVS had been in the top. Actually, it was actually in the top large cap stocks. It's going to fall out of that this week based on the chart. So CVS is not doing too great. If we go back one more, we'll see. I don't see anything too interesting there. So that's how you can use the top 10 list both. It's a good way to find short candidates too, if you want to. On the Dow Industries, renewable energy continues to move higher. Coal, semiconductors, number 3. Automobiles, airlines. It's interesting about airlines, since the airlines have been taking a hit and may actually lose some business over the summer. We'll see if that has any effect. But these two, renewables and semiconductors, if we go back to the charts page, and we can look at right here, renewable was in the top 10 last week. That's why it's green. We can click on this little box right here and see which stocks were at the top for today. And you see First Solar was up 22% today. Array Technologies up 20%. Sunrun up 8.5% today. Next Tracker up almost 7%. That's just for the day. If we're looking for the week, Array Technologies is up 60% for the week. Sunrun is up 68% for the week. First Solar is up there too. So there's Solar Edge, which has been moving up nicely recently. You can see most of these had been really beaten down, way down near the bottom, and they're all making a run now. So that's an area to maybe take a look at. And then the other one was semiconductors, which was not in the top 10, but if we look at the stocks in semiconductors, these are the ones for just for the day. Wolfspeed is up almost 16%, Laser up 6%, NVIDIA right down here up 5.6% just for the day. And for the week, Laser is the big winner, up almost 65% for the week. ACMR up 28%. So that gives you a sense for which of those stocks inside of those industry groups are the better performers. And each of those industry groups can be found right here on the dashboard. All right, let's talk about Nicholas Darvas. Well, first, let me just go through this up here. We'll look at bonds. 10-year went higher today, almost back to 4.5%. US dollar went lower, which is a good thing. That's good for liquidity. And TLT went down, but started to come back at the end of the day. Commodities, gold came up a little bit after selling off. Oil had a big run higher. Gasoline went higher. So some of those commodities are moving higher again, which may impact next month's CPI. It's going to be very interesting. And here's Bitcoin at 104. So 106 is really the key level that we need to watch. So that's it for Bitcoin. All right, let's talk about Darvas. So first off, I will show you on, this is Investopedia, which is a great resource for anything related to investing or trading. And they have a whole section here on the Darvas box theory, definitions, etc. What I did was I copied this whole thing and I put it in a Word document. And that then allows me to highlight certain areas, because I'm not going to read through the whole thing, of course. You certainly could. Be easy to find. It's on Investopedia, or you can just put in your Google search engine, just put Darvas box theory, and you'll find the Investopedia site for that. So here's the definition. Trading strategy developed by Nicholas Darvas targets stocks using highs and volume as key indicator. So Nicholas Darvas was a Hungarian immigrant born in 1920, and he actually left Hungary in 1943, just as Hitler was coming in, and he emigrated with his sister to another city in Europe. I'll think of it in a second. Istanbul. So he immigrated to Istanbul because they were neutral. And then this book right here, How I Made $2 Million in the Stock Market, can be found on my website, and you do not need a subscription for this. So you can go to the books page, and anybody can go here. And the Darvas book is under Market Wizards. And you'll see right here, how I made $2 million in the stock market. By the way, John Carter's book is on here as well. And John Carter, when I met with him and talked to him, he has a very high regard for Nicholas Darvas. It's one of his um, heroes, basically, trading heroes, Nicholas Darvas. In addition, William O'Neill, who started Investors Business Daily, if you do a Wikipedia search, it'll tell you all about William O'Neill. He died in 23, just recently. But if you go scroll down to the bottom, and it was interesting when I found this, under personal life down here, it says he started donating to his alma mater, and then it shows the people that influenced him. Other investors he studied were Bernard Baruch, Jesse Livermore, Jack Dreyfus, and Nicholas Darvas. He also admired Thomas Edison. So Nicholas Darvas appears as a hero on multiple traders. Most traders really look up to him. Darvas' box theory was created when technical analysis really wasn't a thing. And he basically came across it almost by accident. So the Darvas box theory is a technical tool that allows traders to target stocks with increasing trade volume. Theory is not locked into a specific time, so the boxes are created by drawing a line along recent highs. I'm going to show you one using Netflix. Darvas box theory works best in a rising market and by targeting bullish sectors. So that's important. Transforming 10,000 into 2 million, that's laid out in his book. At a time when technical analysis was still in its infancy, his theory, which relied on drawing boxes around price consolidations, quickly gained traction among traders. Crucial aspect of his work, often overlooked by commentators, was his emphasis on the lure of future technological breakthroughs, an approach that's so ubiquitous now we often miss it. What should come through reviewing Darvas's work is how consonant he remains with financial markets oriented toward the next big thing, not necessarily the tried and true. So he talks about this in his book. He tries to find things that are new technologies. So my basic strategy decided I would always do this. I would just jog along with the upward trend, trailing my stop loss insurance behind me. He was one of the first to really use stop losses consistently, to the point where Wall Street actually had him investigated because they said he was the cause of a market decline because he was using stop losses. Really not true, but Wall Street investigated him for that. As the trend continued, I would buy more. When the trend reversed, I would run like a thief. So despite being primarily a techno strategy, it does depend on fundamental analysis. He called himself a techno fundamentalist. So he finds growth stocks. He finds ones that are trending higher. It's a trading strategy that involves buying stocks that are hitting new highs and selling when they fall from these peaks. The approach uses boxes defined by recent highs and lows to signal entry and exit points, guided by price and volume as key indicators. So he uses both of these, price and volume. This method is particularly effective in identifying momentum and trend in rising markets. Basically what a lot of technical traders use today. They just call it different things. His only access to stock information, this is really interesting and it's laid out in his book as well, was weekly issues of Barron's, which he used to study stock prices and volume data from afar. He traveled with his sister around the world with a dance routine that he would do across the world. So he was a ballroom dancer that stumbled across stocks almost by accident. He was dancing in a little club. It doesn't correctly talk about this in this article. It just says that he stumbled on it. But what actually happened was he was in a nightclub in Toronto, and the nightclub owner couldn't pay him. So he gave him some stock certificates instead. And Darvas had no idea what they were. He threw them in a drawer, and 3 months later, he pulled them out and looked at them, and they had tripled in value. And just from that experience, he decided to start studying the market. But since he was so far away from Wall Street, he couldn't place orders on the same day or even the same week. So he would order Barron's magazine, and he started studying stock prices and volume data over time. And that's how he started to develop his box theory. His most famous trading period occurred between 57 and 59 when he turned the initial investment of 10,000 to 2 million. This is important because this period was a super bull market. It was part of the secular bull market during that period, which actually ended in 69. And it started right after World War II. And that secular bull ended in 69. And that's when Darvas made all of his money. Now, he had done all the work and all the study. He started trading way back in 1952. That's when he stumbled, bought shares of a Canadian company. This is what the nightclub owner gave him. So that was 1952. So for 5 years, he studied all of the charts, started identifying what looked like a good chart. So when the bull market began, he was ready to take advantage of it. So right here, the roaring market was up 50% the previous 2 years. He also had an article in Time magazine because he was so successful. This was interesting too. In his bestseller, he depicts a time when he suggested a particular investment to a secretary. This is the cost of fundamental analysis. The latter's father insisted he buy the stock only after a detailed analysis of the company's fundamentals. That's all well and good, Darvas said, but as the secretary waited while the old man was carefully examining the books, the stock went up to 50, a 40% gain. He, but not Darvas, missed. So fundamental analysis can cause you to miss opportunities that technical analysis will identify. So box theory in practice encourages traders to focus on growth industries, those that investors expect to outperform. Selected a few stocks from these industries when developing the system. While monitoring these stocks, use volume as the main sign of whether a stock was ready to move. If you notice unusual volume, he created a Darvas box with a narrow price range based on the recent highs and lows of the trading sessions. Inside the box, the stock's low for the given period represents the floor, and the highs are the ceiling. When the stock broke through the ceiling of the box, Darvas would buy the stock and use the ceiling of the breached box as the top stop loss for the position. This isn't exactly what he did, but I'll show you. As more boxes were breached, Darvas would add to the trade and move the stop loss order up. The trade would generally end when the stop loss order was triggered. So that's basically, in a nutshell, the Darvas box theory. Several methods tend to focus. Are there any other theories similar? Turtle trading system, developed in the 1980s. And by the way, on my books page, you see The Way of the Turtle. This talks about two successful investors decided that they could teach people that it did not have to be a internally developed skill, that you could teach the skill of trading. So they went out and found 20 people that had no trading experience, and they taught them how to trade. And that's what this book is all about. They're called The Turtles, The Way of the Turtle. Excellent read if you want to check it out. All right, so that's one. Popular momentum strategies, trend following, volume indicators, volume weighted average price, or VWAP. This is heavily used by day traders. On balance volume, this is measures the volume flow to predict changes in stock price, and adding volume on days the price goes up and subtracting it on days it goes down. And then accumulation distribution line, which I've covered in a previous Technical Tuesday, identifies divergences between stock price and volume flow, which can indicate the potential for price moves. Accumulation distribution basically measures if the stock is being accumulated at the end of the day versus distributed if it's being sold at the end of the day. So it puts more weight on stocks that move higher in the second half of the day. So that's basically what the Darvas box theory is all about. I encourage you to take a look at his book, read his book, and it's a very entertaining read. It's a pretty easy read, actually. And some of the other books in here are really good too. So there's lots of really good learning in here, including technical analysis over here on the left side. All right, let's take a look at Netflix. And here we go, Netflix. So I already drew the boxes. This is the Darvas box theory, basically, in a nutshell. If we start down here, and by the way, I actually have a training session that I did for subscribers If you go to webinars and newsletters, and on the right-hand side over here, there are some videos that I did for training purposes. Technical analysis, it's a 3-hour masterclass, part 1, part 2. And I think part 1, indicators, yeah, so support and resistance. Part 1, I use Netflix, and I basically show how to use support and resistance and how to set stops as the stock moves higher. It effectively is the Darvas box theory. It's basically the same idea. So if we go back here to Netflix, Darvas would have started down here. First, he would have identified a growth stock that looked like it was going to move higher because it had good technology. So he would identify a box. Remember, he's getting the prices a week late. So he draws a line across the top, or resistance, and he waits for it to make the lowest low, which is support. And then when he identifies the lowest low, he draws a box around that. And then he waits until it goes out of the top of the box with high volume. That's really important. So that'll happen right here. So that's where he buys. He buys more. Contrary to what some people say is buy when it pulls back and then buy more when it pulls back. He actually did the opposite. He bought when it broke out, and then he waited for the next box. So here's where the next box, it broke out here. He bought some on this volume. It went up, made a high, started coming down. He said, well, okay, that might be the top of my box. Doesn't mean it will be. And in my video, you'll see what I mean, but he puts a line there, and then it comes down, and he's looking for the bottom. He's looking for where the low is. So it comes down to this low, which happens to be the same as this low back here, and that is support. Now, he may have drawn a line down here, waiting to see if that was the low, and then it went lower. He may have drawn a line there, but as long as it doesn't go through the top of the box with big volume, then he still stays in the box. So as it starts to make a little bit lower low, he'll just move the bottom of the box down. And he's waiting for it to break out. Now his stop, the way he actually did his stops was he would first put it at the bottom of the previous box. And only after it broke out of this box would he move it to the top of the previous box. So when it was in this box, his stop was down here. Remember, he bought here, so that would have been a loss. Then when it broke out right here on big volume, it went up again. So now it's out of this box, and he's waiting for another box to be made. At this point, he moves it to the top of the previous box. So that's where his stop loss is. So now it moves up, and it comes down, comes right back to the top of this box, goes up, down, up, and down. This whole time, he's moving his lines up, and he says, okay, is that the top of my box? That might be it. And then it pulls down. So there's a low right there. It goes back up, makes a high, starts coming back down, but it doesn't make a lower low. So he puts the bottom of the box there, makes a high right there, and then pulls back. And so that right there becomes the top of his box. And then again, when there's big volume right there, he's waiting for it to break out. So he's got the big volume there, and then the breakout right there. Also more higher than average volume, but he had it also a couple of days before. So he buys more. So he's bought some here, he's bought some here, and now he's buying more right here. Goes and he moves his stop to the bottom of the previous box. Now it goes up. First he makes the top right there. He's waiting to identify the bottom, so he might make it there, but there's no volume breakout, so it goes down here, and then it starts to go higher. And there is a volume breakout, but it is not breaking out above the box. So that is not a place where he would buy. He might do a trial buy there because even though it's inside the box, it's on high volume, but he really wants it to be outside the box. So he'll stay there. His top of the box was there, but then it goes a little bit higher. So he moves the top up again, and the bottom of the box is there. And then when he gets over here, now you've got high volume again. And this box then is complete, and he buys more right up here and moves his stop now to the bottom of this box. Now it continues to go higher. He gets a bottom of the box there. He would have had a top right there looking for high volume, would have had it again right there. again right there. And then finally over here, he's got the high volume breakout above the top of the box. He buys more right there, and he moves the stop up to the top of the previous box here. So right now, this is where we are right now. He bought more here. It's moved up. It comes down, so he puts his bottom of the box there. There's the top right there. Comes back down again, and then right here, it breaks through the top of the box again right here on high volume. So he would buy more right there, and he would move his stop up to the bottom of the previous box. So this is a strategy. In this particular case, it spans basically 1 to almost 3 years. It is still running, but almost 3 years. He's bought once, twice, 3 times, 4 times, 5 times. He's bought 6 times, 6 entries in this, and he has not been stopped out yet. And now his stop is way up here, even though his average price is probably somewhere down here. And that's the way he made that $2 million. And because of the time period he did it in during a secular bull market, he was able to do this with multiple stocks, and they all paid off very handsomely. So that's basically the Darvas box theory. I highly recommend you go take a look at his book. You can get it right on my website on the books page. You don't need a subscription or any of the other books on here. And it's a very interesting read. I also highly recommend John Carter's book, of course. All right, that's it for today. Hopefully that was of interest. Let me know what you think about the Darvas box theory. Let me know too if you read the book or if you have read the book, and tell me what you think about it. I've actually, in my spare time, I've actually written a feature-length movie script about the Darvas's life, which is why I know a lot about what he actually did. And it's a really good story. I actually gave it to Derek Huff, who is a dancer with his sister. So Darvas had a brother and sister ballroom dancing show in the 50s, and Derek and Julianne Huff are a brother and sister ballroom dancing. I actually gave it to him. I literally handed him the script, but I have not heard back. I don't even know if he's read it. It's a really good story, and at some point it's going to get made. I am confident it's going to get made into a movie at some point someday. All right, that's it for today. Thanks for watching. Let me know what you think. Please like and subscribe, and anything else you'd like me to take a look at the rest of the week. Looks like the market is continuing to head higher. I don't expect it to go straight up like it is, so it needs to consolidate and pull back a little bit at some point. So be prepared for that when it happens. But that's it for today. I will talk to you again tomorrow. Thanks, everyone.